Left the room, and I do want to bring him in. A couple things are clear here to me, Steve. Number one, it seems the Fed chair believes that the tariffs have put both sides of the mandate into question, and they're going to have to wait and see on how to deal with all of that. And that Powell himself doesn't seem to be a huge fan of these SEPs either. And he revisited the refrain from the last meeting, throwing back at the reporter who asked him the question, what would you write? We'll do the best we can. Because they just don't know. And he pretty much told you to take it with a grain of salt without using those exact words.
Yeah. And by the way, the grain of salt is actually a number in the in the SEP where they talk about the uncertainty, and those uncertainty levels around their own forecasts, they acknowledge to be very high right now. I guess when Jeffrey was talking, Scott, I remember the day I was on a boat and I had a east-west swell, a west-to-east wind, and a north-to-south rip. The waters are very turbulent right now. And it's interesting. Well, first, let's hear what the Fed chair said about the outlook and what might be coming this summer.
One of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
So, Scott, it's something that we were talking about. He did say he expected a meaningful increase in inflation, and that's something I think that's very important for what the market is expecting. And it hadn't seen it. It maybe thought it was out of the woods, but that's not the expectation of the Fed or any of the forecasts that I've been talking about for several weeks now. What is really interesting, Scott, if you take a look at the changes to the forecast, something is going to not happen there. Here we go. We reduced GDP by 0.3. We raised PCE by 0.3, and core PCE, and we're going to cut the funds rate essentially by 50 basis points. I don't think you're going to cut the funds rate by 50 basis points if you get a 3.1% core PCE. And if that GDP number happens, well, I don't know what happens in that case, but I just don't think you're going to get that 50 basis points of cuts if indeed you're going to have that increase in inflation. That's why I asked him about scenarios, but he wasn't necessarily willing to give me the details on it.